Before we talk about real estate, we want to start with real life because that's where everything actually begins. We're moms, wives, friends, business owners, and women navigating busy seasons just like everyone else. And this first half is exactly that. It's a catch up, a check in, and a chance to get to know us as people before professionals. Before we talk about real estate, we want to talk about real life. My name is Ashley.
I'm Avery.
I'm Riley. I'm Amanda.
And we are the 417 Homegirls. Good morning.
Good morning.
Yay. We are here with Avery, and we have a special guest today. This is Andrew, and he is a lender with Gershman Mortgage. So if you guys have ever felt overwhelmed by the loan process, because it can be pretty overwhelming, then this episode is for you. Because today that we have Andrew here to break down what actually happens from the moment you say, I want to buy, to the moment that you close. So welcome in, Andrew.
Thank you.
You're
Thank
welcome.
you.
Yeah. Happy to have you.
Today we're talking all things credit score, pre-approval, underwriting, down payments, closing costs, negotiating price, all of the good stuff. Some of it complicated, but we're going to try to make it as not complicated as possible.
Yeah. So no confusing banker language, just real talk.
Andrew.
All right. So let's just dive in and start at the very beginning. You know, we see on social media and groups, I want to buy a house. Where do I start? What do I do? So let's start from the very beginning. Someone messages us or we see that post out there. I want to buy. So what actually happens next?
At the beginning of it, I like doing a phone call, like a phone consultation with them to go over all the different steps that are going to be in it, get them realistic expectations, because I feel like sometimes it can just be hey, this is what we need, but you're actually, there could be a whole lot more, and it just depends on the situation that you're doing. And so I like getting all that information up front, and then I'll typically, 99% of my people want to do an application over the phone or online. Most people don't come into the office anymore. I'm more than happy to do an application in person, but most of the time it's over the phone or an online application. So I'll send them that link, and then they'll get that application filled out, and I'll let them know what documents that I need to be able to get that pre-approval started.
What are some of those documents?
Most of the time it is a 2 years worth of W-2s, and that's going to be for all jobs worked in the last 2 years. So if you've had 3 different jobs, in the last 2 years, I got to have W-2s for all of those. Your 30 days most recent paycheck stubs, and then your 2 months of bank statements and a copy of your driver's license is typically what I need.
Very good.
What if they're self-employed?
So if you are self-employed, typically there's 2 different types. It'll be on your personal tax returns, and if it's just on your personal, then I just need your 2 years worth of tax returns for your personal. If they have their own business that has business tax returns, then I need your 2 years worth of business tax returns and your 2 years worth of personal tax returns. So it just kind of depends on which way it goes.
Okay.
Yeah, because it can be confusing, but it sounds like, like you were saying, every file is different. So every situation is different. But yeah, it's good to know some things. So what about credit? So we hear that a lot, I don't know if my credit's good. What does my credit need to be? It's not good enough. I can't buy a house. So what happens there, with credit?
Yeah, so I hear a lot of there's cutoffs and everything. Of hey, if you're below a 640, then this happens. And if you're below a 580, then you can't do anything. And in reality, it's why is your credit where it's at? If it is low, is it because there's a bunch of late payments? Is it because you have credit cards maxed out? Is it because there's a bunch of collections? And those all play factors into it. So it's more of, let's do that application. Let's see where you're actually at. And if I can get you pre-approved, great. Let's go ahead and get that process started. If I can't, then let me explain to you what we need to do to get that.
And I like that you do that. If you're not, if you can't yet, then you help them out and to help them, and it's free to talk to you. I think a lot of people don't realize that. It's free to chat with a lender to go over that stuff. Just having a conversation is where you start.
Yeah.
And talking about what you need to do. If you're not there yet, that's okay. Or if you think, hey, I want to buy in the next year, well, then that's where you need to talk to Andrew and get where you want to be, whether it's your credit or what documents you need to get. If you just started a new job, I know that can play a factor in there too. So
100%.
Yeah.
And the easiest thing with credit is there's not if you're below a 580, let's say if you've got the money to put down maybe 10%, it might flip that file over to where it could get approved now versus, if you just have the minimum payment down, well, then maybe we do need to get your score above that 580 mark to make it work. So it really depends. Yeah. There's really no way to nail down you need this credit score to do it.
I think a lot of people feel my credit score is a 600. I know there's going to be no options for me. And I try and stress to people, you have to start the conversation with the lender first,
Right.
because you truly don't know what they will be able to offer. I know, like, different places are able to offer different things, but also you might be able to help them to where maybe in like 6 months or a year they'll be able to buy. Whereas if they hadn't started that conversation at all, then they wouldn't. In 6 months or a year they'll be in the same position that they're in now.
Yeah.
Yeah,
And
definitely.
one of the biggest things with that too is like if you're a 780 credit score and you've had the same job for 2 years and the file's super easy, then yeah, you don't have to like do everything as I say. But like when you're a 580 credit score and I need you to do this, this, and this, that's when it's really important to listen to like what I'm saying and do it, do it. There's only one way to do it sometimes. And if we don't go down that path exactly, it could, kill the whole deal.
Yeah.
So it's just, if you'll listen to what, a lender has to say and follow, that stuff, then it makes the whole process a whole lot easier and smoother too. So.
Yeah. Now, I have dealt too with, I used to go to high schools. We used to go to high schools together and talk to classrooms about credit scores, because I think that's so important to seniors, going out into the real world and what that takes to, and we talk about credit. So a lot of times, and we've also dealt with some that don't have credit at all. So what would you say to somebody that's starting out, or they don't have credit? What's one way to build their credit? And then can they buy a home without credit?
Yeah, so there's definitely programs out there that will let you buy a house with no credit. I always say no credit's better than bad credit. So you can definitely do it. Sometimes you got to have a little bit more money down. Sometimes we got to start bringing non-traditional credit into it. Like, it could be Netflix bills or utility bills or, stuff like that. The best way to build credit, though, and you just have to be responsible with it, is get a credit card. Don't max the credit card out. Keep, 20 to 30% limit of your limit on that card. So if you get a card and it has $1,000 limit, don't go over $200 or $300 on that card at any given time. But use the card, because if you don't use the card, then there's nothing reporting. So go get a tank of gas, pay the tank of gas off, and then just keep that cycle going along. So use the card, but just it can hurt you worse if you put a whole lot of money on there, max it
Have to be
out. Now you got
responsible.
bad credit.
Yeah.
Now we're trying to build from, low credit versus no credit. But if you get a card and you do it right, you can build get up to a mid 700 credit score in 6 months.
Wow.
So yeah, I even did that with my wife personally. Whenever, I met her, she had no credit score. Me being in lending, that wasn't going to work out. So I was like, all right, this is what we're going to do. And by 6 months later, she had a mid 700 credit score. And it's not hard to do, but it's hard to, if you're at if you missed a payment on something and now you're at a 610, it's hard to get up to a 750 from a 610. But if you have no credit, you can do it pretty easily. But you got to be responsible with it.
So that was my next question. Because I see people online too say, I have just such bad credit, or maybe they're getting out of a divorce or some kind of situation where, somebody else has ruined their credit or hurt their credit. So how long does that take? And I know that they can chat with you and build steps to help get their credit up, like what to pay first, what to do this,
Right.
But how long, like let's say it's just tanked. So how long would it take someone realistically to get their credit up to where they could then financially look at purchasing a home?
Yeah. So, sometimes it can be a year. Sometimes it can be 2 years. It just really depends on what's on that score or what's on that credit. And if it's a bunch of lates, like how soon were the lates? Were the lates a year ago, or are they still actively getting lates whenever I talk to them? And that could push that off, because some of our guidelines are like you can't have, a certain amount of lates in the last 12 months or last 24 months. So if they just recently had a late, well, then we might be waiting a year or 2 years just for our guidelines. And I always suggest, like, if I can help somebody, I'll help them.
Yeah.
But if not, let's get you in touch with a credit counselor, because they can actually negotiate things on, like, if you have a collection and that collection's, for a rental lease or something and it's $2,400, well, that credit counselor could go to them and say, hey, we can't do $2,400, but we'll do $1,500. Will you take it off the credit report? And so, they can actually do that, where I can't do that. So I can tell the clients to do that, but the credit counselor can actually do it most of the time.
I do have like 2 people that I know that are in a program similar to that, where they, go to a counselor or they go to a company that pays it off in like bulk. And then I guess like they make payments to them.
Yeah.
How does that look for you as a lender for somebody wanting to buy a house who's clearly trying to like help their credit, but maybe their credit's at like a 620, but they have, maybe it was like an 800 and then they've got all this bad stuff, but now they're trying to fix it. Do you need to wait until that stuff like falls off or that program ends? What does that look like for you? Or is just every situation different?
Every situation's a little different. I'll run it through my underwriting system to kind of see like, hey, there's two different things. I can get like approve or an accept eligible, which is more of just like not a streamlined process, but a little bit easier. And then there's a manual underwrite, which comes up as a refer on my end. And so that's when you got to jump through a little bit more hoops. You got to get like 12 months of rental history, and you got to make sure that they don't have those certain amount of lates in the last 12 months, 24 months. So it really just depends. Like if their score was 800, well, why is it 620 now? Like what happened to it? And a 620 credit score, it very well could just go through just fine. Like on a government loan, it could be just fine. So it just really depends on that situation and why the score is where it is. Like if they just maxed out their credit cards and then they just, lumped all those into one loan and now they're paying that down, well, that might boost their credit score up too.
Right.
But if it was that they've had 6 90-day lates, or what I see a lot of is the student loans going bad because people will defer those student loans and then they never realize that, hey, now I got payments on these things. Yeah.
Avery.
So that it's just one thing that like a lot of people don't think about. If you get a bunch of junk mail, you might not notice that they're sending you mail trying to set up payments.
Unfortunately, I noticed.
Yeah. And, and I'll see sometimes where there's 20, 90-day lates on a student loan, and it's just like, I don't know that it has as big of a factor on your credit as like a late on a student loan as like a credit card, for instance. But I mean, if you stack up the lates on those student loans, it's going to drop your score for sure. And then like with the credit cards, if you just maxed them out and then I see fluctuations because I'll put a lot of money on my credit card and then I'll pay that credit card off and my score might move, 40 points just based on one credit card.
Okay.
So, yeah.
So speaking of student loan, so that does play a factor. So if you have student loans, that is part of what you look at. Okay.
Yeah. So student loans on a conventional loan, I either have to take, if there's a payment that's reporting on the credit report, that's the payment I go off of no matter what. Typically, on a conventional loan, you either use 0.5% or 1% of the balance. So if there's, a $20,000 student loan, then I got to factor 0.5% or 1% of that for a payment on there. So if I've got somebody that's got $150,000, $200,000 worth of student loans, now we're looking at a bigger payment on there. FHA is 0.5%. USDA is 0.5%, and then a VA loan, if they have like a deferred, if it's in the credit report saying like deferred and it's past a year, then sometimes I can get away with not including that in there. But VA's calculation's weird. It's 5% divided by 12, so it's a little bit different.
And so for those listening, those are loan types. So VA, USDA, and FHA are government loans, and then conventional is the conventional loan. So those are the kind of the names of those loans. What about medical debt? Does that play a factor?
Not really. I don't pay too much attention to medical debt.
Okay.
I think that it's from what I've seen, and I'm not a credit counselor. From what I've seen is like if you get a medical collection, it's going to bring your score down a little bit. But it's not necessarily going to keep bringing your score down, just from what I've seen. Again, I'm not a credit counselor, so I don't know exactly the ins and outs. But like, I'm not factoring a payment in on that. And if it's a medical collection, they're the easiest to work with.
If you defer, going back to student loans, if you defer your student loan, is that a negative hit against you or anything?
No.
Okay.
No, you just got to watch, like from a financial standpoint, you got to watch, like if you're deferring it, are they still putting interest on there?
Okay.
Because, I've had some people where they're shocked whenever I tell them what their student loan balance is.
Yeah.
Because it was 60 when they graduated. All of a sudden now it's 95. And they're like, well, I haven't added anything to it. I'm like, it's just that interest just keeps building on there. So
good to know.
If you're not making any payment, is interest still building?
Yeah.
That's what you got to look at.
Perfect.
So.
Okay.
Going off of people's medical debt, student loan debt, and how people keep track of their credit. Obviously, if you're not getting new loans, you didn't buy a new car recently, you haven't bought a house recently, whatever, you might not know what your actual credit score is because you haven't had a hard credit pool. But people like me, for instance, I still use Credit Karma just to look at and keep track of it, make sure there's nothing
100%.
like bad. Nobody's stealing my information or anything, I guess.
Right.
But as somebody who has worked, doing lending with like vehicle loans and stuff like that previously, I had a lot of people come in and say, well, my credit score on Credit Karma was 750 and you just did a hard pull on my credit so I could buy this car and it's, 640. What, that's got to be wrong. What do you say to people who have that reaction when they, watch their credit on Credit Karma?
Yeah, so any of those like Credit Karma, Credit Wise, pretty much every credit card company will have their own little estimated generating system, and that's what they are. They're estimated generating systems. They're not doing a full report. Typically, they look at everything in the last 90 days of, hey, what was your score before? What have you done in the last 90 days? This is an estimate of what your score can be around. I've seen them where they are 100 points off. It's more rare. Normally, you got a 15 to 20 point fluctuation. Sometimes our score is higher than what Credit Karma is showing too, because typically credit cards, like the credit card companies, they'll only report to the credit bureaus once a month, maybe once every other month. And so you could have had a high balance whenever, they reported last, but now whenever I go to pull your score, you could say, hey, my card's paid off, but it's not reflecting that because the credit card companies haven't reflected to the credit bureaus yet. So the Credit Karma, it's an estimated generating system. It's not a true report. And then on top of that, there's different models of credit reports. And so, we're going to look at everything in the last 7 years from a mortgage standpoint. So we've probably got the hardest pull that not affecting your score, but like we're looking at everything, in the most depth versus like an auto loan, that's going to be a different score than what we pull up. Whenever they're checking for insurance quotes, they're typically doing a soft pull, and it sometimes doesn't even give them a score. It'll just be like excellent, good, bad, whatever. So it's not like an actual score. So there's different models and everything. And then even going from different lenders, I pull from a certain company, and if a different mortgage company pulls from a different credit bureau type of deal, not credit bureau, but credit
like
servicing.
Equifax versus.
Well, I have Equifax, TransUnion, and Experian. That's what we all look at. But I pull through a company called Equifax Mortgage Solutions.
Okay.
And that pulls all three of them for me. Now, a different company could pull through to get the actual information from the credit bureaus, and we could have two different scores. We could pull at the same time and have two different scores. So it's super hard to actually nail down exactly what your credit score is. But
It's like a Zestimate.
it is.
Yeah.
It is.
You don't know until you know. Until you talk to a professional, you're not going to know.
Yeah. So it's just depending on, what am I actually seeing versus like what it is now. And you could do like rapid rescores. Like if you had a card maxed out, but now that card's paid off, like we can update the credit bureaus and stuff. It costs a little bit of money, but we can do it. And a lot of times it makes a big difference. So
Good to know. I didn't even know that.
Yeah, there's different stuff that you can do on there.
So speaking along the lines of pre-approval and rates, so we talk about a little bit about shopping rates. So number one, what does that look like when people can shop rates like they can with insurance quotes? So they can also do that with their lender.
Right.
And then also talk, also talk about how long does that pre-approval last for? And so the timeline there.
Right. So to start on the pre-approval timeline side, so a credit report is good for 120 days.
Okay.
So from the time that I pulled out, we just had to close within 120 days before I got to repull credit. To update a new pre-approval, it takes me no time at all. I just got to repull credit, and then I get some updated income docs and everything, and then I can just reissue a new pre-approval letter. So, and then as far as shopping lenders and everything, I always tell people like, hey, you need there's an act in place to where you have, it's either 10 or 14 days of a grace period to shop with different lenders. So like if they pull your report after I pulled it, then it's not really going to negatively affect you. I wouldn't suggest going and talking to 20 different lenders.
Right.
But get a few that you want to talk to, and then but do that typically before you go under contract on a house. Now, if you do it after, it's not a huge deal, but a lot of times they're using the real estate agents are putting in that pre-approval letter, with the offer. And sometimes that mortgage company has, they have a good reputation in town or whatever, and that can help your offer get accepted sometimes too. So if you switch it up, a week after going under contract, the sellers could be like, hey, what's going on? Or the listing agent.
It does raise red flags.
Yeah. So I always suggest talking or before you commit to one, right as soon as you go under contract, let's figure out hey, because the market's always moving. People are always having different interest rates. So let's see where your interest rates are at. But yeah, I always suggest if you're going to shop before you go under contract or right when you go under contract, figure out, talk to your 3 people, 4 people or whatever, and then check in with them once you go under contract and say, hey, what are the rates doing?
And from a realtor perspective, I always say shop before we even look, because you need to kind of know I feel, and maybe you can agree with this, that most people think that their monthly payment is the most important.
Right.
So yes, I might be pre-approved for 300, or the internet says I'm pre-approved for 300. This app, but you don't want to spend that much on your payment each month, because you also have taxes and insurance to factor in there.
Yeah.
So with that being said, when we go shop houses, I don't want you looking at something that you can't afford or don't want to. We always say house poor. We don't want you to be house poor. So I always encourage talking to Andrew or, a lender to talk about what is important to you? What's your monthly payment before we even really go shop, before we go under contract, because you don't want to go under contract and then realize your monthly payment, and then it's too high, and then it's the stress there. So
if you go under, or if you go under contract, now you're late in the game if you're like, hey, my payment is not where I want it to be, because now we're not doing good.
Right.
But before that, like if you go out and look at houses and you're looking at a $300,000 house, and both of you guys can attest to this, if you're looking at a $300,000 house, we run some payments on it, and you're like, hey, this is way higher than what I want. I actually need to be looking at $225,000 houses. You already saw $300,000 houses. And now you're going to start comparing this $225,000 house to a $300,000 house, and it makes it super tough. It makes it tough on the realtors. It makes it tough for the buyers, everybody on that. So, and
I love how you said that, because it does remind me that, first of all, that you're local, and so that's wonderful. That's one reason why I know we love working with you, because I have texted you all. When I'm out showing at night on the weekends, like, hey, I am at this house. I screenshot it. You're like, just send me the house. You look up taxes and like the rough estimate of what it could be, and you're there all the time, like always answering when I'm showing, and I can immediately tell my client, hey, it's going to be this amount. So it's not waiting for over the weekend. And I deal with that sometimes when I have the seller side and I'm trying to work with the buyer agent, and they're like, well, the lender's not back until next week, Monday, or they're out of town. And I'm like, okay, so it's just harder. But so that is a very good point that, you are there to ask those questions. And while we're showing houses, I've done it.
Yeah. And I mean, it doesn't take hardly any time, especially, looking up. Now, if you're way out in the middle of nowhere and the taxes are not very accessible online, then it can, it could be a little bit more of an estimate, or, if it's on, I don't have access to like Flex MLS. So like, I can't just see like I'm kind of using Zillow, unfortunately, sometimes. And
hey, it's okay.
Yeah.
It's not a bad thing.
Yeah. I'll trust the taxes on there sometimes. So, but I always like to double check on those. So, but I mean, I don't know. You've texted me and I've came back with a payment, a couple minutes. It doesn't take a long time. No. It's not like it's a big deal.
You sent me a pre-approval at 10:32 p.m. one night. So it was like we needed to get the offer sent in by the next morning, if not that night.
That was a conversation that I had with my wife when we first started getting serious. So I was like, hey, like this is just, it gives me a lot of freedom, but it's a job that
this
I'm
is a
working
lifestyle.
all hours.
Bless her.
Hey,
Bless her.
And we know. We know. We've been through it.
Yeah. So, but with like, the other part of shopping too is if a lot of mortgage companies, they're all going to have very similar rates. I mean, we all are competing with each other. We're all going to have similar rates. It's just like gas stations. Like the one across the street might be a cent less, but all of them are pretty similar. So if you talk to somebody, and I say, hey, we are at 6%, and then you go to talk to somebody else and they're at 5.5%. It's like, well, why are they at 5.5%? And if they're at 5.5% and they're not charging anything for 5.5%, I'm going to tell you go with them all day long, because I want you to get like you're my client, so I'm wanting you to get whatever's the best for you. So if they're actually at 5.5%, I'm going to tell you to go that way. But let's look at their loan estimate and let's see, for one, are they charging you points to get that? Because a lot of times, rates don't make as big of a difference on payment as what some people think. Like some people are like, oh, hey, it's a 0.25% lower. It's probably going to be $150 cheaper a month, when in reality it might be $20. It might be $25 a month. So it's like if you're charging $4,000 to get this interest rate, but it's only saving you $30 a month. Well, let's do the math on that. Let's see how many years it takes for you to even see that profit on there. And you guys might know a little bit better. I don't know how long like the average person stays in a house for, but I know even most of the time people are going to refinance once or twice before they even sell the house in the first place. So it's like, what if you spent $4,000 and then rates came down, 9 months later. And so now you did a refinance. So that $4,000 that you spent is completely wasted now. So it depends.
So true.
It's looking at the full thing. And that's why I tell people, send me a loan estimate. And if So if you're getting a better deal somewhere else that I can't offer, I'm going to tell you to go that way. But I want to see that loan estimate first before I can tell you that confidently.
Yeah, because a lot of people will advertise, hey, I see somebody will advertise a really lower rate, but it's true. I mean, you're buying down the point. So let's look at the overall picture here and see if it's really in your best interest.
Yeah. And sometimes it does work.
Yeah.
Sometimes it works.
Exactly.
So.
I like that you are honest and we trust that.
Sometimes it works.
So speaking of like getting pre-approved, so once you're pre-approved and you say, hey, you're pre-approved, I'm going to send this pre-approval letter to your agent. Are they done?
No.
So what happens next?
Well, so they're free to go look at houses. They're free to put offers in on houses, get in that negotiating time frame of like, hey, we'll give you this price, but we want $5,000 in seller concessions, or we want, this fridge to stay, or whatever it is. My job really from there is once they're pre-approved, I'm just running payments for them at that point. So like or answering questions or whatever it is, but my job's kind of done until you go under contract. Then that's when I start back up. I'm going to order, those disclosures. Once you sign those disclosures, we're going to get that appraisal ordered, get title work ordered, get verifications of employment ordered, all that stuff. So
a lot of communication.
Yeah.
A lot of signing. Yeah.
Yep.
So question, because this is important for realtors as well. Pre-qualified versus pre-approval. So kind of talk about the difference and what they really need. Is pre-qual just as important as getting pre-approved, or would you rather be one or the other?
I would say 99% of the people that I work with, I just get them pre-approved. One thing that I've learned from this business is like some people, they just don't know, and I don't mean this mean in any way. They don't know how much they make. They don't know what their actual, credit score is or what they have in their bank account or that type of stuff. And so, again, going back to the point of like, I don't want them looking at a $300,000 house if they're actually, and I send a pre-qual letter for $300,000 because what they've told me makes sense at $300,000. And then, they're looking at houses and then they're ready to get actually fully pre-approved. And the difference is like fully pre-approved is I've, looked at their income docs, I've looked at their assets, I've looked at their credit, I've ran it through my underwriting system. You can even go a step above that, which right now we're even running like a $500 promotion if you get fully pre-approved, which is through the underwriter and everything. So the underwriter even looks at the file and they say, hey, based on everything that you've sent so far, this is a done deal. And so when it goes through underwriting, we're still waiting on title work. We're still waiting on appraisal. There's still stuff that can come up. But as far as their income and assets, we've got those already covered.
That's awesome.
But I can send a pre-approval letter with just me looking at it. It's not a fully underwritten pre-approval, but it's, I've looked at income, I've looked at assets. And so that's what I like to do most of the time because I want people, for one, I want the real estate agent to feel confident. I don't know, if there's as much confidence there in a pre-qual letter as there is a pre-approval letter. But I prefer the pre-approval letter because it doesn't take hardly any time. Just give me your income documents and I can get it out. So
pre-qualification is just kind of like a conversation, and pre-approval is where you're actually verifying that they are.
Yeah, and like a lot of times when it's a pre-qual, it's more of like, hey, I'm looking out 8 months away from now or a year from now,
and they
but
don't
I want
want that pull.
But I want to get like everything ready to go. I want to make sure that like. We could do a soft inquiry instead of a hard pull on there. And they just want to know that everything that they're doing from now until the next 8 months, they're on track to be able to buy a house in the next 8 months.
Okay.
So,
very good. So agents, if you're a listing agent, you want that pre-approval, or if you're showing houses, pre-approval.
Okay, so now we're going to kind of switch gears slightly, talking about the big thing: down payment, closing cost. The actual like hard numbers, the money side of it. So I know that every buyer is going to look completely different, but let's talk about what people actually need as far as, the government loans versus conventional, all that kind of stuff. What do you think people need as far as down payment, closing costs, all that kind of stuff?
Yeah. So I'm going to just talk on like the traditional mortgages. There's non-QM products, which is non-qualified mortgage products. And that's a whole different world, and there's just a bunch of different scenarios for that. But as far as like just your normal conventional FHA, VA, USDA loans, so VA and USDA, they're both 0% down. USDA is a rural development loan. So like in our area around here, you can't use it in Springfield, Nixa, Ozark, or Republic, or Battlefield. But all those other surrounding areas outside of that, you can use that in. So And they, not recently, but within the last couple of years, took out NICSA, Ozark and Republic, which did put a damper on the USDA loans around here. We used to do a whole lot more of them. But those are 0% down. VA, you got to be a veteran for that. It's only for the veteran and the spouse, and that's another 0% down. And then there's conventional. If you're a first-time home buyer, or you can qualify for that Home Ready, Home Possible, you can do 3% down. Well, you have to be a first-time home buyer for the 3% down. And then there's that affordable program that you can stack on top of that.
For conventional?
For conventional.
Okay.
And then the standard conventional minimum is 5% down.
Okay.
Yeah.
So not 20%,
no.
but everybody.
Yeah.
Yeah, talk
20
about that 20%
Yeah,
and
so-
why people, that's a big number.
Yeah. So 20% down is, you can put that down and then you don't have mortgage insurance on the loan. But you do not have to have 20% down. I would say 70% of my conventional loans don't have 20% down.
Yeah.
Standard, no matter how many times you bought a house, any of that stuff, standard is 5% down for a conventional for minimum. And then FHA is 3.5% down. So, and then you can stack, you can stack like a bond loan on top of that. Like there's the MHDC program, which is a Missouri grant, and that's a 4% grant. So like if you did 3% down or 3.5% down, you could get a 4% grant to stack on top of that. And that's a whole nother conversation. Sure. They're a little bit tricky and there's some stuff to it, but it's a great grant. So
I hear a lot of times.
Go ahead. No, you go ahead.
I hear a lot of times first-time home buyer loan. Is there such a thing?
Well, a lot of people think that an FHA loan is a first-time home buyer loan.
I think it's
not.
the initials.
Yeah, I think it's the FH. Yeah.
First-time home buyer.
Yeah. So FHA loan, I could sell my house now and go buy a house with an FHA mortgage, and I've owned a couple of houses. So you don't need to be a first-time home buyer for that. And just so that we're clear, in our world, a first-time home buyer is somebody that has not owned a house for 3 years.
Oh.
Yeah. So like if you bought and sold a house 5 years ago, you're considered a first-time home buyer.
Wow.
Yeah. So it's just within the last 3 years. The biggest part for that first-time home buyers thing, that's like just your standard thing, is the 3% down on the conventional. Yeah,
okay.
That gets you in the 3% down. And then you can, like I said, you can stack like the Home Ready, Home Possible programs on top of that, which is an affordable program. You got to make under a certain amount of money, depending on the income limits of the area. And that will help you out with your interest rate and your mortgage insurance.
So I could be a first-time home buyer because I've been in my home 9 years.
No, you've owned a house in the last 3 years. You can't own a house in the last 3 years.
You can buy
Okay,
and
so
sell.
if I bought and
If
sold
you
and like rented or moved in with my parents, because I see sometimes people do that.
Yeah, 100%.
So then they don't own a home for 3 years. I gotcha. Okay.
Yeah. So, or, what I see a lot is, unfortunately, with divorces. Somebody went through a divorce and then they've rented for 3 years or whatever, and now they're looking to get a house. Now they're considered a first-time home buyer again. So,
And they can use that 3%.
Yeah. Yeah. You just can't own a house for the last 3 years.
Gotcha. Okay. That makes
Yeah.
sense.
Not
If you
that you
were-
bought it.
I just want to say, if you are a first-time home buyer or a buyer in general, and really first-time home buyer, and all of these terms and the lingo and stuff that we are trying to explain, and we are explaining, sound weird or like you've never heard of that before, this is why it is so important that you talk to a lender, because there are so many different programs and ways to go about getting a mortgage without putting 20% down like people think. So I think, again, starting the conversation with a lender is vital. Start it now. Even if you plan on buying in a year, start the conversation now. It will cost you and the lender nothing to start the conversation.
And there's a lot of different programs like FHA and conventional. You might be approved for both of them, and both of them might have similar payments. But as you guys know, on like a conventional, they have a little less requirements on the condition of the house versus an FHA, which is a government loan. And, even if they don't really have that much difference, there's that stigma around an FHA loan that like, oh, it's never going to be appraised. And so if there's two offers on a house, exact same offers, the only difference is conventional and FHA, 99% of the time it's going to be that conventional.
Yeah. It shows
Conventional
stronger.
offer. Yeah.
Sometimes.
Yeah.
Like sometimes people think that. Sellers think that, and the government loans, you're right. They have some stipulations on that appraisal where the house has to be a little bit more sound or safe, and they might call out things.
Right.
To be that they'd have to fix before, that the seller would have to essentially fix before they could get the loan. So, so talk about too, because if you're a first time home buyer or someone trying to buy and they think, oh my gosh, I need all this money. So thinking about down payments and that 3%. So let's say they have the 3%, but that's not all the money they need. And so maybe talk about closing costs and how maybe that we could negotiate that as realtors into an offer. And that's, again, another reason why it's so important to talk with your lender. Agents need to talk with the lender to figure out, if you need closing costs
Yeah.
and how we can work that into
And
the
what
offer.
closing costs are too.
Yeah. Yeah, there's a lot that goes into closing cost. And from lender to lender, there's really not a huge difference in like, like, oh, this person has so much lower closing costs than this person. When the lender, like their really only fee that they have control of is their lender fee. So like sometimes, like for instance, we have a fixed fee. Sometimes they go off a percentage of the loan amount. But other than that, it's really all third party fees. So you're going to have like your appraisal costs, your title fees. The biggest one is setting up your homeowner's insurance and your taxes for your escrow account. And that
all lumps together as your closing costs.
Yeah, so that all
that are due at closing.
So like I might say, hey, closing costs on this one are going to be $6,500, or they're going to be $7,000, and so you can go back to this, or you could go to the seller whenever you make your offer and say, I'll give you $250,000 on this, but I want $6,000 in closing cost or $7,000 in closing cost, and so as far as like everything that goes in there, the two biggest things for closing costs that whenever a realtor asks me like, hey, what's closing costs going to be on this house, and there are two big ones that can swing that amount a lot, is your homeowner's insurance and your prepaid interest. So that goes off of your closing date. So if you close towards the end of the month, you're not going to have very many days of daily interest on there. But if you close like on the 9th or whatever, you might have 21, 22 days worth of prepaid interest. And, if that prepaid interest is $40 or something a day, that can be $500, $600, $700 added to your closing costs versus, if you close at the end of the month. And then the other thing is homeowner's insurance. So typically I got to collect 14 to 15 months worth of homeowner's insurance in closing costs. So I have 12 months as the monthly or the yearly premium that goes out to the insurance company right away. So at closing, if you close March 31st of 2026, you're going to be covered on that house from March 31st of 2026 to March 31st of 2027. We're paying that as part of your closing costs. And then we got to also collect, 2 months or 3 months worth of a cushion in case that homeowner's insurance goes up, so that whenever it's due next time, there's still enough money in that escrow account. So if you, and I'm going to pull up my calculator. So if you get a quote that's say $150 a month, which is $1,800 a year, and you got to collect 15 months, that's $2,250 in your closing costs. But if that insurance is, higher and it's $200 a month, now you got to collect $3,000. And that's a difference in $700 that I don't know about, until you get an insurance quote. So, and then if you have that prepaid interest, maybe that's $500 more. So, this, from what I'm telling you, it could be $1,500 off one way or the other.
Gotcha.
In just two things. Yeah. So, and how an escrow account works, because a lot of people don't know how an escrow account works. So when you make a mortgage payment, there's 5 things that are in your mortgage payment. There's your principal, your interest, your taxes, insurance, and mortgage insurance. All 5 of those, you make one payment, and that goes out to the servicer. And then the servicer divides that up where it needs to go. So your principal, your interest, and your mortgage insurance, those are all sent out every month, and they're paid every month to the investor, to wherever that needs to go. And then your principal or your taxes and your insurance are put into an escrow account, because taxes are always due at the end of the year. So we got to make sure that there's enough money sitting in that escrow account so that when the tax bill comes out, there's enough sitting in there to pay for that. And then also homeowner's insurance. It's always due a year out from when you bought the house. It's not due at the end of the year. It's due a year out when you bought the house. So it just really depends on, you might have a whole, like if you close in February, you might have a whole lot of money sitting in your escrow account come November, because it's about to pay your taxes and your insurance. So it just depends on that. And that kind of plays a factor into closing costs too, because it's like there's an aggregate set up and all that. And now we're getting into the weeds of it. But there's a lot that goes into it. So, and those numbers are constantly moving. That's one of the toughest parts. Like we're going to send out an initial loan estimate, and it might say one number, and then by the time that we get all the way to closing, it could be a whole different number. So it's tough.
So what about a cash buyer? How does that look for closing costs? Because obviously you don't have an escrow, like, you don't have to have those items because you're not getting a loan. So kind of,
so
what does that look like?
I don't deal with cash buyers because I do the loans.
Okay.
So,
that's true.
Yeah, but so you're going to pay, you're still going to have title fees.
Okay.
So you're going to pay for your title fees. Typically, unless you waive your right to the appraisal, you're still going to have the appraisal cost, which is, somewhere around $500 normally.
If they choose to get it.
If they choose to get it. Inspection cost, so it's more of just
And then their insurance, they just pay it out.
They just pay it out of pocket, typically.
Okay,
Yeah.
gotcha.
So now you can, as you know, like you can always send invoices to the title company and have that put in there so that you just have to pay one thing and then title will disperse it where it needs to go. I'm pretty sure that's how it works on cash. I don't know for sure. That's how it works in our world. But you can have title disperse those funds where they need to go. But it's going to be quite a bit less cost because we don't have to get a credit report. You don't have to get, you're not paying our fee. You're not paying for the debt monitoring. You're not paying for the flood cert, all that stuff. So it's going to be quite a bit less if you run through just with cash.
Yeah.
So.
And so just listeners know, like as buyers and real estate agents, so again, I like to talk to Andrew and say, hey, do they need their closing costs covered? Or you're like, hey, here's their pre-approval, but they definitely need their closing costs paid up to, at least $6,000 or whatever. So as real estate agents, we then try to work that into an offer so that those can be covered or technically built into your loan. So sometimes we can offer a little higher to appease the seller that they're still getting the same amount essentially if we close there. But they're allowed or not allowed, but they're able to give us those closing costs.
Yeah, and there's percentages on those as well. Yeah. So like on a FHA and USDA deal, you can ask for up to 6% of the sales price. Now on a conventional, if you put 3% down or 5% down, you can only ask for 3%, and a lot of times 3% is not going to cut it of the sales price because if you're buying a $175,000 house at 3%, that's $5,200. That's probably not going to cover all the closing costs. Now it might, but it probably won't. So you got to look at that too, because if you get 175, typically once you get above a 250, you're going to be fine. But like if you're 250 and under, you really got to start looking at those percentages of like what you're asking for, because you can't ask for $7,000 but only be allowed to get $5,200.
Because the rest will go to the seller. You don't get all that.
Yeah, and you got to renegotiate it and all that stuff. So looking at those, talking to your lender and figuring out like, hey, if we offer this, how much can we ask for in seller concessions? And like I said, most of the time, if you're above 250, you're going to be fine.
Well, and two, if they, if you work it out where they pay a little bit more, can you buy down that loan a little bit? Like you can use some, you're trying to use as much as that as you can.
Yeah, like if we have $7,000 in seller concessions, but our closing cost is coming out to $6,500, well, we can't apply that extra $500 to the down payment. So let's figure out where we can apply it to, because if we don't use it, it goes back to the seller. And so if there's nowhere to use it, or it doesn't make sense to buy the rate down or whatever it is, then we're going to be looking at, hey, let's try to drop the price of the house by $500. And it's a pain, but it's better than it going back to the seller sometimes, because you guys agreed on this price of what the seller's going to net at the beginning, and now they're netting $500 more. So
I really want to talk about this real quick because it's very important, and you touched on it earlier. So here's where I see buyers get emotional when we're doing that offer. So a house is listed at $350,000. The buyer wants, let's offer $340,000, and the seller won't budge. So that's $10,000, and in the grand scheme of things, that sounds like a lot of money.
Right.
But on a 30-year loan, what is that? I mean, what is that really at 6% or 5% now where we're at? Where does that $10,000 really leave them?
Yeah, I mean, it's not going to be as big of a difference as what a lot of people think. $10,000, it is a decent amount, so it is going to be, it might be $100 or so, difference a month, and I'd have to look at the numbers to get an exact amount. But it's not as big of a difference as what a lot of people think, and it really depends. Like that's when you really got to lean on your realtor and just say, hey, like, what is this house actually worth? So if I need to sell this house in 2 years and 3 years, like, if I pay $340, great. But if I pay $350, like, is it still gonna appreciate above $350 in the next couple of years? So that's what you got to look at. But I mean, and that's another thing. Just communicate with your lender and just say, hey, will you run a payment at this at $340 and $350, and will you tell me what the difference is, and see if it works in your monthly budget? Because
it could be a difference of $70. So you could be losing a house over $70 a month.
Yeah.
Because you're spreading it out over a 30-year loan.
Right.
So it sounds like a lot of money, like, woo, but when you really kind of break down the numbers, it may not be as bad as you think.
Yeah, and if you absolutely love that house, it might take you 3 months to find another house, and, what are you paying currently? What's your interest rate currently?
Or rent.
Or rent, or, what happened to interest rates over the last 3 months? Are they now 0.5% higher?
Yeah.
And that payment's $70 higher anyways.
Yeah.
So...
Okay, so what is the difference? There's a few different terms that I think can get confused. What's the difference between recasting and refinancing? Because obviously people hear in the headlines, like, mortgage rates are down, and they want to refinance. So can you kind of talk about the difference between refinancing and recasting your loan?
Yeah, so a recast on a loan is you're keeping the same loan. All your terms are still the same. Your loan, that how many months you have left is the same. The interest rate's the same. Literally everything's the same. The only difference is like you might owe $250,000 on the house, and so the your payment's based on that $250,000. But let's say you got a huge bonus at work, or you saved up some money, and now you got $50,000 to put down on the loan. If you do a recast on it, it's going to drop your payments. So you say, hey, I'm going to give you $50,000, but I wanted to do a recast on the loan. So it's going to now base those new payments on the principal that's left over. If you don't do a recast and you put that $50,000 down, it's not going to change your payment. It's just going to take terms off the end of the loan, like years off the end of the loan, because you owe less, but you're still paying a higher amount. So you're going to pay it off quicker. So it just depends on like which one you want to do. If you're comfortable with the payment and you got some extra money to throw at the thing, well, maybe you don't need to do a recast. Let's just keep making that same payment. But instead of paying the house off in 30 years, you might pay it off in 19 years or 20 years or whatever. So it just depends on what you want to do there. That's the kind of difference between a recast and just putting the money down. Now, the difference between a recast and a refinance is a refinance, you're paying off that old loan and you're doing a whole new loan. So you're gonna get a new interest rate. You're gonna get new terms. Like everything is new about the loan. The only thing that's the same is the property that you're refinancing. But
Do you have to bring money to that? Does that cost?
it does cost. There's going to be title fees. If we got to order another appraisal, there's going to be appraisal. There's going to be stuff in there. We'll waive our origination fee on that. Especially, we'll do it for most refinances, maybe even all refinances. But definitely, if you're a past client of ours, we'll waive that origination fee. We've already charged you once for it. We don't need to charge you again for the same property. But there is fees that go into that, and that's why you got to look at, is this refinance make sense? Maybe I'm saving $50, but it's costing me $4,000 to do it. Is it worth doing it? What I like to see when I'm looking at a refinance is, does it make sense, and are you going to see the profit in the next 12 months? Like, is it going? Are you going to be able to, like, if you're saving $100, or $200 a month, are you making enough savings to where it justifies that cost of doing it?
Yeah.
So,
Someone once told me wait at least a point on the interest rate to drop
Yeah.
to really even consider.
Yeah, especially on
refinancing.
your lower loan amounts, like anything, say 250 and lower, like I like to see a point. If it's above 250, now we can start looking at 3/4 of a point. If it, if you got a really high loan amount where your payment's really high, 0.5%, it still might save you $200, $300 a month. So it just really depends on what your loan amount is. But yeah, on that 250 and lower, I like to see a point most of the time.
Question on the appraisal, because I get that sometimes. I'll say, if I'm meeting with a seller and they're like, but my house just got appraised like a year ago.
Yeah.
Is that a true appraisal when they do a refinance or if they do a recast, or is it a drive-by?
So
Appraisal,
there's
or
not
they're
an
just
appraisal
looking
on
at
a
it.
recast.
Okay, so it's a refinance.
A refinance, yeah,
Okay.
it'll be a full-blown, most
Like
of the time
they'll
it's
go
a
out,
full-blown.
they'll take pictures, they do the whole market. Okay.
Yeah,
All right,
yeah,
good to
because they're still making sure that the house meets our guidelines,
Gotcha.
the lender
Okay.
guidelines. So if there's any repairs that are done. Now, if there's enough property data, and as technology keeps advancing and everything, like I'm getting more and more appraisal waivers, meaning I don't need to get an appraisal on the property. And so
we love those, by the way.
yeah, it helps out. It streamlines the process. Now, I have had people where they're like, no, I want to know what the value is of the house. And so we'll still order an appraisal. We still have that ability to do that. But if you've got that appraisal waiver, we don't have to charge for it, for one. And you don't have to, and that's more of just like what is your loan to value? Do you have plenty of equity in the property? And is there enough data on that property? Like if it's a new construction house, there's no data on that property. Or if it's a house that, somebody lived in for 40 years way out in the country, there's probably not a lot of data on that property.
Yeah.
So it just kind of depends.
Yeah.
So.
Well, Andrew, this has been awesome. So last little bit here about renting. And I think the whole point of everything that we've talked about, whether it's recast, refinancing, getting a loan, credit, anything, is just having the conversation, starting that conversation. Should I recast? Should I refinance if you own a home? Should I buy a home? What's my credit look like? What's this? It's just having that conversation. Even talking about any of that is free with any lender.
Right.
So I think just reaching out to you, getting that education piece from you, what's the best, because like he said earlier, he's going to look out the best for you, and he's going to educate you the best way that he can for you. So I think just having that conversation is going to is where you should start.
Yep.
For sure. So if you guys are out there and you don't understand, you're not supposed to understand everything. We've been doing this for several years. We especially Andrew has been doing this. This is his specialty. So he knows the ins and outs of everything. And I learned a lot today. So thank you for being here for sure.
Yeah. And I don't know what you guys do on a daily
Yeah.
basis. You don't know what I do. Like, it takes
Right.
everybody to be able to do
Exactly.
it. So I don't know. I sure don't know what insurance is doing over there, but I just send it over there to them and let them deal with it.
I know
So,
people always ask me, can you tell me this and numbers? I'm like, okay, if it's number related, Andrew, we're calling him right now because I don't want to mislead number one. And I'll tell you an estimate and give you the best thing that I can. But if it's mainly numbers, we're going to Andrew because
I will send you Andrew's phone number. No problem. Yeah, no problem. You need an answer? Here's Andrew.
Yeah. So it's not about knowing exactly everything today, but it's knowing the right people and who to talk to and who to explain it to. So we're so glad you were here today.
Yeah.
So informative. So thank you for being here. And as always, listeners, reach out to one of us, any of us. We have Andrew's number. And we just thank you for being here today.
Yeah.
It's awesome.
Awesome. All right, y'all.
Have
We'll
a good
see you
day.
next time.
See you next time for episode 6.